Bloomberg Audio Studios. Podcasts, radio, news. This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
This week on the podcast, I have an extra special guest. What can I say about Deven Parekh, Managing Director at Insight Partners, major venture capital / private equity shop that has had just countless exits. He was an early investor in Twitter, Buddy Media, eVestment, Appriss Insights, Website Pros, Turnitin. They focus on software, which is much broader and more varied than you might imagine. They are global in their footprint of where they put money to work, and they're not just early stage investors. They do A rounds, B rounds. They will help provide liquidity for a company that's looking for a partial exit, as well as strategic investments and M&A, sort of from a private equity shop. I think Insight Partners is unique because they have a foot in both venture and PE worlds. I thought this conversation was fascinating, and I think you will also. With no further ado, my discussion with Insight Partners, Deven Parekh.
Thanks for having me.
So let's start out way back when. You get a bachelor's in economics from Wharton. What was your original career plan?
Not business.
Not business.
I actually, in high school, was a total science nerd. Competed in Westinghouse International Science Fair.
What area?
Biochemistry, microbiology. Actually won first place in microbiology at the International Science Fair. So my path was kind of being a doctor, or probably being an MD, PhD. I didn't actually start Penn in Wharton. I actually started in the College of Arts and Sciences. I started as a biochemistry major. I was doing research at the medical school my freshman year. I think like at everything in life, there's a lot of fate in who your roommates are and the people you meet. And, my roommates were all business. And I was the only kind of science person. And I thought, well, maybe I should take a finance course or an economics course. I did freshman year, found it really interesting. And after my freshman year, I decided rather than working in science for the summer, I was going to work on Wall Street for the summer. And I managed to get a job in Wall Street between my freshman and sophomore year, which was unusual at the time, but I did. And I came back after that and said, well, maybe I can put these two interests together. And I was going to do biochemistry and finance. I was going to do the dual degree, with a degree in Wharton and a degree in college. Now they have preset programs for all of these things, but at the time they didn't. But it would involve taking, between 6 and 7 courses every semester, and not these were not easy classes. These were like organic chemistry and quantitative finance. And I just thought this isn't going to be a great college experience if I do both. I kind of needed to pick. And so I ended up picking Wharton. And of course, people are like, well, what was the thought process you went through when you did that? And the thought process probably was not I was impatient. And I saw the route for medical school was I was going to do 4 years of medical school. I was thinking at that point I also wanted to do research. I thought maybe I was going to get a PhD. It just seemed like a long time in school before I could actually start my career. As opposed to business, I could kind of jump in right away. And I always thought that at some point in the future, I would somehow bring these two interests together. I didn't know how.
That was the obvious question, because on the list of areas you invest, I don't see a whole lot of healthcare or biotech or genomics. But have the twain ever met? Or?
They actually have, and they have in two different ways. We do now have a team at Insight that does invest in kind of therapeutics, biotechnology kind of therapeutics. We have a team that does it. I'm involved in it, but I'm not the one doing those deals or leading those deals. But it's actually probably also manifested a lot more like philanthropically. I'm on the board of NYU Langone. We're funding a bunch of research there as well as a bunch of other, kind of universities. So philanthropically, it's been a big focus of mine. And so it's been I've been able to bring that kind of interest back into my life in a way that's been satisfying.
Really interesting. So from Wharton, how do you end up on Wall Street? What's your first gig?
Well, I worked for the summers. I worked at a small buyout shop after my freshman year. After my sophomore year, worked at Credit Suisse. And after my junior year, I was actually at First Boston at the time. After my junior year, I worked at DLJ. And then I started at Blackstone. And that's
quite a laundry list of
it was a laundry
firms.
list.
Yeah.
It was a laundry list. And I started as an analyst at Blackstone in 1991. And then had the opportunity, even kind of before I finished my analyst program, to go to a startup, but it was just not a tech startup. It was a investment banking startup that was founded by Jeffrey Berenson and Ray Manella, who used to be the co-heads of merchant banking at Merrill Lynch. And so I left Blackstone to go to what was then a no-name, and to some degree it's still not well-known firm. And I remember having a conversation with my dad at the time, who was like, he didn't really know who Blackstone was. And so when I took that job, he was like, well, why would you take Blackstone when you got all these offers from firms he'd heard of? And I was like, well, I think it's going to be a really good firm. And then finally he got comfortable that was a good idea, and I leave to go to this firm that no one's heard of. And I said, well, my downside case is I'll go to business school. Like, it's really not anyway, so I made that leap, and that was it was a great experience. They were primarily kind of M&A advisory, but then over time they were trying to figure out how to get into the principal business in some way.
How do you go from M&A to venture capital?
So the two co-founders of Insight, Jeff Horing and Jerry Murdoch, started their effectively the predecessor to Insight at Berenson Manella. And Berenson Manella was kind of a sponsor of these two guys who wanted to do something in technology really early. We were not technology experts. The firm didn't know anything about technology, but we thought we could help them raise capital, or at least the guys who ran the firm thought they could help. But we didn't really have a lot of competency in software. I was the closest thing they had to somebody who understood technology, which just means that I used it. And so I was kind of working with Jeffrey and Jeff Horing and Jerry Murdoch. And then they kind of came to the conclusion that they were going to kind of go do this on their own, that there wasn't really, like, the partnership didn't make sense for them. So they went off. They'd asked me.
What year was that?
They, 95.
Yeah.
And they asked me at that time if I was interested in joining. And, I was 25 and a vice president. And I was like, oh, well, why would I go join a startup? And now all of a sudden I lost my startup kind of bug. And so I didn't then, but I maintained a relationship with them. And then in 1999, when I was thinking of leaving Berenson to go do something on the principal side, I ended up kind of joining them when they were raising their first institutional fund.
So what was that process like, going from what was really a startup to going to something that was barely no longer a startup, or was that really their first major outside fund?
They at that point had raised 3 funds. Mm-hmm. They were about to raise their 4th fund.
So somewhat seasoned.
It was primarily at that point they had very few institutional investors. So their 4th fund, Fund 4, was going to be their first institutional fund. And so the firm was very small from a number of people standpoint. It was about 10 people. Today we're 450 people, so it's a much larger firm today. But it was, I think the harder part of the transition is, it's very different being an advisor, which I wanted this transition, but it's very different being an advisor whose goal it is to kind of get a deal done, to being a principal where your goal is not just to get a deal done, but it's to make sure it's a good deal, right? And that's a shift. That's a shift in mentality. It's not like an on-off switch for that. But really, the way I looked at it is and the firm that I left very generously offered me the opportunity to take a pool of capital that they had and invest in technology as kind of as a way to maybe get me to consider staying there. And I said no, and it wasn't really an economic decision. What I said was I'm not really qualified to do that at that point in time. And that one of the reasons I'm making this shift is to actually learn how to do something.
What was that learning curve like? Because I remember the 1990s and the late 80s, and it seemed like a ton of people were just jumping into the venture worlds regardless of their credentials or academic qualifications.
Well, I think I joined at late 99, 2000. You remember that time.
Sure.
In some ways, it was a great time, and in some ways it was a terrible time. Mm-hmm. I think in retrospect, it ended up being a very good time for the following reason. Economically, it was not a great decision for years because, I think I told my wife when I took the job, we just bought an apartment and she was pregnant with her first kid, and I said, "Don't worry, I know I'm making less cash, but I'm going to have all this equity." And that equity was like 5 years. I hadn't really. She was like, "I'm not sure. I'm not sure I feel like this was the right trade." But so you get there in '99, and the deal pace is frenetic, and so you think like, "Oh, I'm learning so much. I'm getting all these deals done." I also got put on a ton of boards, of companies, and the first thing I figured out was, well, a lot of these companies didn't really have a business model without raising a lot more capital. It wasn't just us. It was just that was that
sure.
time.
It was a land grab.
It was a land grab in the early days, and the market corrected very quickly. I think 4 or 5 months after I got there. And when you look back, I mean, those were really, really hard years. But I actually think this is where you learn the most. It's easy to be a cheerleader when things are great. It's a lot harder to have to kind of dig into a business, including businesses that aren't going to make it, and try to get to the best possible outcomes. So from a learning standpoint, and I think this is sometimes the things I tell my kids is like the worst times sometimes are the ones where you're going to learn the most. And there's always going to be, you're going to get to the other side. It might not be the side exactly the way you wanted it, but there's no way you're going to look back and say you didn't get something out of that experience.
It's so funny you say that. I started on a trading desk, and one of the things you figure out pretty early is you learn much more from your losers than you do from your winners. Same thing in venture?
Same thing in venture. I think it's the same thing in life.
Oh, really?
Yeah, I think it's true in lots of things. It's
Stumbles and fails are more instructive than...
It could be jobs. It could be relationships. It could be, even like right. If you think about the world today, where your world today, where there's a tendency for parents, and I'll include myself in this, to be too involved. Right? Oh, my son got a B because he had a bad teacher. Guess what? We all have bad teachers and bad bosses and bad roommates, and but you learn to adapt. And I think sometimes you have to go through those things, and I think you learn from them. Right? Bad relationships, I think you learn something from. So I think you have to, if you take the mindset that you can learn something in good times, you can learn something in bad times. I'd argue you probably learn more in the bad times. I think it's a valuable mindset to try to have. It's hard to have it when you're in the
Sure.
bad time.
You mentioned the role of serendipity earlier. Michael Mauboussin likes to point out part of the reasons we may not learn much from the good times is it's very hard to distinguish between, hey, is this working out because I'm skillful, or is this working out because I just got lucky?
Rising tide lifts all boats.
Yeah, that's right.
And you don't know whether you're on a yacht or a boat with a hole. But they all rise because the water's rising.
At least temporarily.
Yeah, exactly.
That's right.
Yeah.
So you mentioned you're on a ton of boards. U.S. International Development Finance Corp, Council of Foreign Relations, Carnegie Endowment for International Peace, NYU Langone. What's the attraction to all these boards?
Well, those are the things I do, outside of the office. I think I've always had a belief that if you're successful, you kind of owe it to give back. So that's one. Two is intellectual interest, right? Like the things that I'm involved in are things I've always been really interested in. And even in some of these, I talked about how I ended up going to Wharton because of who my roommates were. Another story was when I was in college, my freshman year, I went to go write for the newspaper, the Daily Pennsylvanian, which is a pretty well-known college newspaper. And my roommate at the time went to go volunteer for College Democrats. This is first semester freshman year. Second semester freshman year, I asked my roommate to come check out the DP, the newspaper, and he asked me to do the same. And senior year, I was president of College Democrats, and he was editor-in-chief of the newspaper.
Huh.
Right? Neither would have happened without us kind of having totally different interests, and he's now in journalism, right? So, I just think that there's a lot of these things, and so that interest, policy-related things, is an interest I've had ever since college, and kind of over time, I've been able to engage in those things in a more meaningful way.
Coming up, we continue our conversation with Deven Parekh, Managing Director of Insight Partners, discussing how the firm developed its expertise. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. My special guest today is Deven Parekh, Managing Director at Insight Partners, where he helped oversee over 140 investments, many of which have had exits. So let's start chatting about Insight Partners' approach a little bit. You guys do everything from software investing to AI. How do you differ from other venture capitalists in the space?
So I think the approach that we take is we're really software investors, but we're stage agnostic. Right. And what does that mean?
Meaning not just seed, angel, B rounds?
Probably the only stage that we don't really play is seed and pre-seed. But we'll do everything from a Series A all the way to a buyout. We have the capability to go across the continuum. And I think that's important both ways, right? Like if you're a buyout investor, as an example, particularly in a field like technology, which is changing quickly, not knowing what's going on at the early stage, what could be coming that's disruptive, is kind of a risky way to be investing in more mature companies, particularly in an AI world where that transformation is happening a lot faster. And the flip side, I think on the early stage side, understanding what does it take for a company to actually be public? What does it take for a company to actually be able to raise the B's and C's and D rounds? And what are the key metrics to make and having the network and ecosystem to be able to help companies do that? It's helpful to have your mid-stage and growth stage business too. So I think the ability for us to be able to invest across that continuum really makes us pretty unique relative to most other software investors out there. The second thing is, the way we source, though more firms are doing it now, which is, we have over 60 people full time. That's all they do is deal sourcing. And think of it as our outbound sales team, but it's a really smart outbound sales team that are people who, when they're successful, end up being partners at Insight. And what we're able to do is have tremendous market intelligence because we're talking to anywhere from 20 to 30,000 companies a year, right? Obviously investing in a much smaller set of those. And then the third thing is our kind of a value add approach, right? Because all investors like to say they add value. It's hard to do. We very early on in 2000 created what we call Insight Onsite. And the reason it's called Insight Onsite is because those team members are meant to be on site at the company as opposed to in our office, right? So think of it as McKinsey or Bain. If you walk into the office, you won't see a lot of those people in the office because if they're doing their job, they're actually at their clients. And in our case, our clients are our portfolio companies. And what we've done is if you think about every functional area of a software organization, whether that be sales, marketing, product, customer introduction, strategy, and now AI transformation, we have a team for each one of those areas. And we have a team for each one of those areas that's also stage focused, right? So we have a team that works with early stage companies. We have a team that works with mid stage companies. We have a team that works with more mature companies because the recruiting needs for a company with $500 million of revenue are very different than the recruiting needs for a company with $5 million of revenue. And that team is over 125 people that's focused on really making sure that the companies, they're getting the benefit of not just anything we know, best-in-class thinking outside the firm, best-in-class within the portfolio, and those three things together is really, I think, what allows us to have a very successful strategy.
Really interesting. I was trying to conceptualize how Insight is sort of a venture fund, sort of a PE shop. Your explanation really explains why those titles and those descriptors really only describe part of what the firm is doing.
And I think things are blurring, in this world. Like, one of the areas that we're very active in right now is something that we call venture buyouts. And you'd say, well, okay, like that seems like that's both. Right. And to some degree it is. But what is it really? Well, what's the biggest issue you hear right now in private equity? If you were to interview an LP, they'd say, well, I'm not getting enough money back. I don't have enough DPI, and so I'm over-allocated. That's probably the number one complaint that institutional investors have. Well, if you look in venture, there's just a massive amount of funding of companies and company creation and funding over the last – so you have thousands of companies out there. Many of them have not reached a scale where they're ready to go public or have a strategic really be focused on them, right? They just don't have the scale yet. And what we're able to do in those situations is find the ones that are interesting companies, and we go to the shareholders and say, we'll buy 70% of the company, we'll buy 100% of the company. You can either choose to roll some of your investment if you think there's upside. If not, we'll give you a return, whatever it is. And then we're able to then take control of those companies. What happens in a lot of these venture companies is they have very diffuse cap tables, right? You have 7, 6, 5 different people, 5 different opinions. It's actually hard for the CEO to get alignment with their board on what the strategy should be. We can create that alignment. And so maybe he or she wanted to execute an M&A strategy, but only half the investors were willing to put up more capital. We're able to, in that case, clean up the cap table and then make whatever changes in strategy, team, whatever it might be that are necessary with a totally aligned board. That's a strategy that touches both. It touches some element of venture and it touches some element of private equity.
Two of the people you work with, Ryan Hinkle and Richard Wells, as I'm doing my prep for this, anywhere I search for software as a service, I seem to come across Ryan Hinkle's name. Tell us what it's like working with those guys and working with the other founders, the 2 co-founders.
Yeah, and others. Mike Triplett and Jeff Lieberman. And we have so many people who've kind of contributed to the success of the firm. Ryan actually joined Insight as a summer intern right out of college. He's now on the investment committee. Richard Wells joined us out of Harvard Business School after a successful career at TCV and some other firms, and has been a huge driver of returns. He's had some great deals that have exited just this year. I think that one of the things that we're most proud about at Insight, and this is also, I think, very different than a lot of firms out there, is that if you look at the top 4 partners, the top 6 partners, top 8 partners, the vast majority of those people all grew up within Insight. And we've really created a culture, if you join Insight as an analyst, you can make it to the top. And that's very different than a lot of firms out there. And I think that's created a very positive entrepreneurial culture where we give people a lot of autonomy. We give people a lot of ability to find new areas to invest in, and magic happens.
So let's talk a little bit about that magic. You've made over 140 investments in various companies. I'm assuming that you're doing this as part of a group, as part of an investment committee. How does that work if everybody has a slightly different expertise or focus? Take us through the process of what companies get funded. How does that process go?
Yeah, and look, first of all, that's the beauty of, I think, our model too, which is while we might all have slightly different focuses or areas, we're all just investing in software. Mm-hmm. Now, if you contrast that to firms where somebody's a biotech partner and somebody's a software partner and someone is an industrial partner, that's much, much harder because you really don't have any sense of each other's businesses. Here, the key metrics are common across all of these things. There might be some technical understanding around an infrastructure product or what might be happening in a particular vertical that a partner might have, but the key metrics are the same. And so our process is that every deal, no matter how small or how big, goes through the same investment committee process. We meet once a week, kind of common like a lot of other firms out there. And the team, whoever the team is, presents the deal to the IC. We debate it. We ask questions. We ask for follow-up information. And out of that either comes this is something we want to pursue, we don't want to pursue, we only want to pursue, but only at kind of this valuation. And the team then goes out and kind of executes on that. And then if, say, we sign a term sheet, they'll come back with a more detailed diligence package that goes through all the typical diligence things you'd assume. That gets reviewed and discussed again. Sometimes there's follow-up questions that come out of that. Sometimes there's not. It has to get through that second approval process. And then if it gets through that approval process, then we would then fund. But before anything even gets there, we have a number of teams that are staffed with these sourcing analysts and associates and mid-level people that really do the hard work before something even gets to the investment committee. So Ryan and Richard both run a team, and they each have their slightly different focuses, but they each run a team, and they're meeting with their team on an even more ongoing basis to kind of prioritize the deals that they want to pursue, and then if it gets through their own team, then they would bring it to the overall investment committee.
So I've heard some venture capitalists talk about valuation almost as if it doesn't matter, which as a public markets guy, I kind of shudder when I hear it. I think it was Mark Andreessen who once said, all right, we were early stage investors in Facebook. Had the valuation been double, it practically wouldn't have affected our returns. My immediate answer was, well, they would have been half if the initial investment was double, but 100x point taken. How do you think about valuations, especially when you're looking at early stage A or B rounds, where it kind of feels like total addressable market, growth projections, I don't want to say fabricated, but they're squishy best estimates.
They're guesses.
Yeah.
Right?
Okay.
I mean, look, but in an early stage deal, like it's a guess. I think the person who wrote a check in Palantir didn't know that Palantir was going to become what Palantir became, but they saw an entrepreneur with a vision, with a potentially large market, and decided to make the bet that this person could execute and turn it into that larger market, right? Look, I'm not going to say the valuation doesn't matter, but I think what you can say is that we have it's a line that one of my partners uses, that we don't overpay, companies just miss their numbers, which is just, I mean, it's said in jest, but really the point is that generally, not always, but generally the price we paid, if the company hit the numbers that we thought they were going to hit, even if the price seemed high on current revenue, feels reasonable. So, companies that even recently, AI companies that seemed expensive 6 months ago, don't look so expensive 6 months later, just based on kind of how their run rate revenue has changed. So the way we think about this is we do care about valuation. We lose deals on valuation. But that doesn't mean the deals that we win aren't high absolute valuations. Mm-hmm. It's just how much conviction do we have in the growth, right? And this is why these markets are not efficient. You can have very high conviction on XYZ company's growth, and I can have low conviction. And one of us will likely be right. And if I was right and did it, good for me. And if I was right and didn't do it, it just depends on who's right. So I think the way we think about it is all of these deals today, certainly AI deals on a multiple of revenue basis, are going to feel expensive. Of course, you have to look at growth adjustment, right? So even as a public market investor, you'd say that a company that's growing at 10% is going to have a different valuation than a company that was going to grow at 30%. Now, how do you even start thinking about a company that's growing at 100%? Right. It's hard to think about. And it's not hard to think about it for a year, but if something can grow 100% for 3 years, and then even if it deaccelerates and compounds off 3 years of 100% growth, that's a pretty high multiple that you can pay. So the way we really think and talk about it is not valuation doesn't matter, but we think about it in terms of if you're paying a high multiple, then your conviction needs to be high on the growth rate. Now, you're not always going to be right? And that's part of the business. We just have to be right enough. And
you mentioned software. The first thing that comes to mind is Silicon Valley, San Francisco, the West Coast. Insight Partners is New York City based. I know you have offices around the world. Yeah. Is there an advantage or disadvantage to being based here in New York?
We think there's an advantage now, but maybe it's maybe we're just convincing ourselves that because we live here. But I think that not being I can tell you what the disadvantages are, but I think the advantage is not being in the bubble. Like, we're not all having breakfast at Bucks and talking about the same 20 deals. Now, maybe that's bad if those 20 deals are the deals you have to be in, but there's a tendency to have everybody kind of want to do the same thing. And I think not being in that every day lets you step back more and kind of decide what you want to do as opposed to what everybody else is doing. I think there's a disadvantage too, like the strategic buyers are all out there. Mm-hmm. We're not in the same flow of those companies sometimes as people who might be seeing those people all the time. But on balance, I think we've done okay, and we've managed to sell to a bunch of strategics, and so I don't think it's hurt us to be here.
And I mentioned you have offices around the world. You literally, it's not just New York, Silicon Valley, London. You guys are all over the place.
It's really four presence. It's New York, it's San Francisco, it's London, it's Israel. Those are really the four places we have.
So how does being global help the firm? What do you learn from having that sort of global perspective?
Well, I think we're pretty disciplined about how we've grown, and I'd be surprised if you see us have, a lot more offices in 5 years. If you take Israel, which Jeff Horing really drove that strategy for us to get into Israel. I think, and I might get the numbers wrong slightly, but I think we had 60 or 70 companies in the portfolio before we put the first person on the ground. Right? And at that point, there were 6 firms that had, 5 to 10 people there that had portfolios of 5 or 10. Right? And because I think the thing that we want to avoid is if you put somebody on the ground before you have a portfolio, then they need to rationalize their existence by creating a portfolio. And maybe that's a good idea, but maybe it's a horrible idea. And by having the bar that if you want to do a deal in Israel or you want to do a deal in India, you actually have to get on a plane and go 10,000 miles or fly 12 hours.
Got to be a really good deal.
You got to be really excited about it, right? And so it creates a natural no, I like this deal in Long Island better. Okay, well, look, you spoke with and it probably should have a little bit of a better return in order if it's that far away, right? And so we've kind of waited in these places to have really conviction that that's going to be a market because we have a lot of companies in that market before we add presence there. So there's plenty of places in the world where we have more companies than funds that are in that local market.
Really interesting. Coming up, we continue our conversation with Deven Parekh, Managing Director at Insight Partners, discussing the state of startup investing today. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. My extra special guest this week is Deven Parekh, Managing Director at Insight Partners. The firm runs over $90 billion in venture capital and various stages of private equity. So you guys have a reputation for being software investors. Why have you focused on that one space? And how many different subsectors are included under software?
Well, look, we've been doing software since 1995. And if you look since 1995 to today, I might be wrong about this, and maybe there's one other category for which this is true, but I don't think since 1995 there's been a single year where the software industry declined in aggregate revenue through every recession, through every cycle. And as a percentage of GDP, it just continues to increase. The software component continues to increase. So, I think if you'd asked a bunch of us 10 years ago, we maybe thought, maybe we're going to cap out on software. We're going to have to go do something else. That really hasn't been a problem. I don't foresee it being a problem. So it's a massive industry who's had great growth, but the projected growth over the next 10 years is very strong. So I think that we don't need a new category to go after. We like this category. This category's got amongst the highest growth rate of any category out there. And it's really well downside protected too. If you had a lender on, they would tell you that software is their lowest loss ratio. Right.
What catches your attention first when you're looking at either a startup in software or a reasonably developed company? Is it the founders? Is it the technology? Is it a combination of both?
Well, I think it depends on stage. I think in an early stage company, founder and tech is really, really important, right? And market. Now, as you said earlier, you're making a guess sometimes on a market at a very, very early, at a Series A stage. Now you're hopefully making an educated guess based on lots of pattern recognition of companies, based on lots of data on how big that market is measured in different ways. But it's a common mistake to underestimate a market, right? I mean, when we look back, it's a little bit more of a consumer example, but when we look back, I remember looking at Uber and we convinced ourselves that how could you ever pay a valuation that's higher than the total TAM?
Right. And
the total TAM was New York and San Francisco of black cars. Well, it turns out that's not really the total TAM of Uber today, right? Forget about food delivery and groceries. I was just talking about cars.
Just yellow cabs.
Yeah, it's just because they went to UberX and UberX totally changed the TAM. So I think TAMs are not static, right? And I think that's a very, very hard thing to recognize that, okay, maybe they're going after a small problem today, but that might be the Trojan horse to get into bigger and bigger markets over time, right? And that's where intuition and pattern recognition and kind of seeing what a great founder is, which is why, look, early stage I think is much harder than growth stage or buyouts, where you have lots of data and financial metrics that you can kind of rely on. Right.
I love the idea of the Trojan horse. Somewhere along the lines, someone said you could practically ignore the seed stage or early stage business model because there's always going to be a pivot. The Trojan horse are the founders. How accurate is that point of view?
Well, I mean, I think it, like in everything, when people make statements like that, they tend to focus on the winners, right? So they'll look at XYZ company that pivoted and say, oh, look, everybody can pivot. Well, everybody doesn't pivot, and you do have a huge, very high loss ratio at seed, early stage, and even Series A. And the strategy is different, right? You have a power law in Series A, you have a power law in seed, and you have a power law even in buyout. It's just a different power law. In buyout, you can basically, your power law is not a lot of losses. You can have some 1Xs or 1.5Xs, but you probably need a couple of 4X or 5Xs. In seed, you probably need 100X, and you have a very high loss. In Series A, you need a bunch of 10 or 15 or 20Xs, but you can still have losses. So depending on what stage, there's this view that like power law only applies to venture. It really applies to all stages. It's just what a loss is defined differently, right? A loss in a buyout might be just a 1X or a 0.8X. You can't really have a lot of zeros in buyout, right? So I think the power law continuum is true across all these markets.
So AI is obviously a really big sector today. What other sectors excite you the most? Or how much does AI fit into just looking out there as game-changing technologies?
Well, look, I think every firm, whether they're a venture firm, a buyout fund, doesn't really matter what type of investing people are doing, I think it'd be a huge mistake to ignore AI, right? Even if you're not investing, quote unquote, in an AI company, you better be thinking about how AI is going to affect your business model or how can it improve your business model. And those who don't, even people in services businesses, like if you're running a law firm today, you're running an accounting firm today, you just really need to think about how is AI going to affect my business. So, of course, in our case, in our more mature companies, a lot of what we're thinking about is how do we accelerate growth and revenue through new AI products, and how do we reduce costs and increase margin through applying AI technology in the companies. Or earlier and mid-stage companies are often AI native. They're actually going after a new market, the legal vertical or construction vertical, with kind of a new AI-focused product. I mean, I think what's true is that every company to some degree is an AI company. It doesn't mean that they're .ai in their name, but every board meeting that we go to at Insight, we're talking about AI. And the irony is even the board meetings I go to at NYU Langone, we're talking about AI. Board meetings I go to at CFR, we're talking about AI. Because if you're a hospital today, you're thinking about how do I have a better experience for my patient? How do I think about increasing throughput? The average wait for a neurologist today across the country is 8 to 9 months to get an appointment. Mm-hmm. Now imagine you're suffering from like a real problem and the doctor says, well, I'll see you, next year, right? That's the average. Now, what if we can kind of get AI to be able to help assess these problems earlier, and all of a sudden you take the data from the best institutions and you make that available in an AI application, so now people in Appalachia have access to the same level of care as people who have the benefit of being able to be near NYU Langone or Mount Sinai, right? And so I'm going broader in my answer to your question, which is I think AI is now affecting everything we do. And so I think every company that we invest in, we're talking about what's the impact, or and then the other thing we talk about is like the other big debate in kind of AI land is what will get owned by the LLMs and what will get owned by the application providers, right? How much of the value will accrue to the models, the OpenAIs and the Anthropics, and how much of the value will accrue to the applications? I don't think anybody can answer that question. We don't know.
So I remember in the late 90s when the .com was just exploding, it kind of felt like a handful of companies were sucking all the oxygen out of the room from everybody else. Is AI doing that? Like I would imagine things like cybersecurity and fintech and other software-driven startups, are they starving for capital, or is there just so much money out there that even AI can't suck all the money air out of the room?
There's a tremendous amount of capital out there, and there are lots of companies outside of the ones that everybody knows that are growing really, really quickly, often serving a vertical market. I mean, what's still true is that if you have an application that is serving a market where there's a lot of domain expertise or data required, you still have a moat. And so I think this, because one of the big debates is, does AI mean that the software companies are going to be dead? We don't believe that. What we do believe is if you have a very generic application that doesn't have any vertical domain expertise, doesn't have any data moat, then I think you're at a significantly higher risk. But I think there's lots of examples. We're seeing them. We're investing in them in specific healthcare applications and legal applications, construction industry, where you have companies that have true business process, vertical expertise coupled with data moats.
What other spaces have you excited besides AI, which is obviously going to have a giant impact? What other areas are really interesting these days?
I think cyber continues to be a really important area, and one could argue. And I don't know if we might just be announcing it. So I don't know whether we announced it yet. We're investing in something that's kind of related to AI-related security. And so every time you have these big new platform shifts, you have infrastructure around that platform shift that's important, right? And so I think we're seeing a lot of next-generation infrastructure investments, cyber investments. So there's a lot of markets that we're seeing. And I think what's happening right now is if I'd answered this question, a year ago, I would say, well, we're doing vertical applications, we're doing these types of horizontal applications, and now it's all getting bucketed into AI because it has an AI angle. But there are subcategories, within AI. There's not like just one AI company out there. There's obviously lots of companies, and it's just becoming that AI is becoming almost like an operating system that all of these new vertical applications are being built on.
I haven't heard you mention crypto. Is that a space you guys explore, or is that too specific?
Well, I'll put it in the past tense. We explored and decided, well, one, we didn't do that well with it, and two, the fundamental problem that we've seen in it is that when these companies would come in, we met with hundreds of companies in crypto. When these companies would come in and you'd say, okay, tell me what it is about your application that makes it better than if it were just in a relational database, right? Like a very simple question. You'd kind of get back all kinds of technical answers and white papers, and I'm like, right, but just as a user,
what problem does this solve that I can't
solve?
Right, I can't use
generally,
SQL for.
We didn't just generally get a really good answer. Now, I don't want to say that there's not going to be any crypto applications that are going to be successful. I'm sure there will be. I mean, obviously, if you talk to CEO of Visa, you talk to the CEO of MasterCard, they'll talk to you about stablecoins and the impact stablecoins could have. Obviously, you have an administration that's very pro-crypto regulatory. So I think you're going to see money being made in that category. I guess we're used to trying to find applications where we see here's a clear business use, here's a clear payment for that business use, and here's how it can scale. We haven't really been able to decrypt that in crypto, but I'm sure there are others out there who understand that better, and I'm sure there'll be some winners, but we've just chosen to not focus on it.
So let's talk about some winners. I see a run of exits that Insight Partners is associated with. You were an early investor in Twitter, which IPO'd, Buddy Media, acquired by Salesforce, eVestment, sold to NASDAQ, Alibaba, JD.com, Duck Creek, Appriss, the list goes on and on. Tell us about some of these exits. You guys really have put together quite an impressive list.
Well, I'd rather talk about our exits from this year.
Okay, so we'll keep it current.
Yeah, so my partner Jeff Horing led our investment in Wiz, which sold to Google. Well, I should say, signed a definitive agreement to sell to Google. Hasn't closed yet. for $32 billion, largest venture-backed acquisition by a strategic. My partner, Richard Wells, led an investment in a company called Central Reach, which does software for autism clinics. We sold that for just under $2 billion to Roper Industries. And then my partner, Jeff Lieberman, led a deal called Dotmatics, which we sold to Siemens for just over $5 billion. And the interesting thing about those deals is one's a traditional early. So we did Wiz as a series, I think B, and then kind of continued to participate along the way. Both Central Reach and Dotmatics were venture buyouts, but the multiples on money were like venture multiples of money.
Really?
Right. So venture returns with buyout dollar deployment. It's a good combination.
Yeah.
And so, and I think we've got more coming over the course of this year. So I think we've had a really strong year. One of the things that I think contributed to that is I think historically we were not great on liquidity. And by that I mean not that we didn't have good companies. We just didn't focus a lot on liquidity. And as big LPs in our funds, we're generally the GP is tied or close to tied as the largest investor in the fund. So we're pretty aligned with our investors. We kind of were focused on multiple of money and not so focused on IRR. I mean, within reason we're focused on IRR, but it wasn't what we – and I think over the last 10 years, 15 years, you've seen a massive transition in the institutional LP base of a shift from MOIC to IRR.
So I want to stay there because it's kind of fascinating. I had no idea, because I don't play all that much in the venture space or the private equity space, that, hey, we have longstanding liabilities that we eventually want to meet. And even though we knew this was locked up for, depending on the fund, 5, 7, 9 years, we'd like to see some exits sooner than later. When did this start happening, and what do you think is driving this?
Well, I mean, it's probably been happening for years, but it's accelerated in the last
post-pandemic.
Yeah, post 2 to 3 years when you had the correction and people felt over-allocated, and 21 had this huge peak of investing, and so now there's this big bubble of investing, but not enough liquidity coming back relative to the deployment. In the last 2 to 3 years, it's accelerated, and so we took that feedback seriously. I don't think we're the only ones who got that feedback, but we actually put a liquidity committee together. It's from people across the firm, both our financial function, our investment team, our operating team, and we now have quarterly liquidity meetings where we target companies for liquidity. We kind of talk about what the IRR is from here, and I think and that was set up about 18 months ago. But I think a result of that is, I don't want to say it's a direct result because you can't press a button,
right.
But a focus on it, everyone talking about it, everybody feeling like they have accountability to that process, I think has led to a lot more liquidity over the last. So I think we've gotten an ROI on really putting focus against it.
Really interesting.
I think, our LPs gave us feedback on it. I think we thought about it. We said, yeah, it's fair feedback. Let's make a change. Let's make an adjustment.
So you mentioned the boom in 21 and then the pullback in 22. You started in the mid-'90s. You've lived through numerous boom and bust cycles. What's your big takeaway from those experiences?
Well, I think when you're living in the depth of it, it feels like it's never going to end, and it always ends. And
this too shall pass.
This too shall pass, and I think it's a hard lesson because listen, the thing that's still the hardest to do is Warren Buffett's investment. Everybody's scared, and you get yourself ready, and you've got your I'm going to move X dollars to the Vanguard Index Fund, and then you don't do it. Why? Because you don't think it's ever going to pass, right? Because if you thought you were going to pass, of course you'd do it. And human psychology is really, really hard to change. I'm including myself in that definition.
It's so difficult to fight the crowd when everybody's running for the exit. You have to be built a certain way.
I still remember when the market, 2008, the market was, was really crashing. And I remember having a conversation with somebody who know the markets really well-known person. He said, yeah, GE can't roll their commercial paper.
Yeah.
Right. And I was just like, holy crap.
That was after AIG and Lehman and
I
September
remember,
08?
And I remember it was like a Friday and it was a long week, and I called my wife and I'm like, honey, let's just like go out for dinner. And she was like, let's stay in. And we're having this like 5-minute back and forth. I'm like, why are we talking about this? And she was like, well, I thought maybe we should save some money. I'm like, it's not that bad. I'm like, we could go out to dinner.
But Ben Bernanke, former chairman of the Federal Reserve, famously sent his wife out to the ATM to get cash in case the system went bad. If he was terrified, it just shows you human nature is we're always going to be scared.
So I think that I don't know that you could ever teach people to like, move money. But I think the hard part is really, besides maybe not making as much money as you could make, the hard part is just feeling like it's never going to end, right? And now having been through this as many times as I have and my partners have, I think it's easier to recognize that there's light at the end of the tunnel.
Makes perfect sense. Let me throw you a curveball question before we jump to our favorite questions. So we talked about AI and we've talked about cycles. What do you think investors in this space, either technology or startup or M&A or ventures, are not really talking about or thinking about, but perhaps should be? What's the most important topic, asset, geography, policy that's getting overlooked but shouldn't?
I think people still, as much as we talk about it, I think people still underprice what happens if there's a real cyber risk. We think about cyber as, my Citibank account got hacked. We think about cyber as, I got a phishing email at work. By the way, all those things are bad and bad things can happen out of them. And, everyone has probably dealt with some version of that.
I'm more concerned about someone taking control of the electrical grid.
And I think we still, I think I don't want to make it sound like the government doesn't think about it. I think they do. Mm-hmm. But I think it's just people. I don't think we realize like the level of risk if physical infrastructure were kind of taken over. And there have been examples of it happening.
Like physical infrastructure, be like the electrical grid or something more specific?
Water purification plants, electrical plants. Hospital systems going down, right?
Well, we've seen a lot of ransomware with that.
We've seen that in individual institutions.
Right.
We've not seen it systemically.
Right.
And that's a pretty scary,
terrifying.
That's a pretty terrifying risk. Now, I'm not saying. I'm answering your question as to something that I worry about that maybe we don't worry about enough. I'm not necessarily sure. It's like I don't know how to price that into the market. It's not really a market answer. It's just something that I think like it's an asymmetric risk.
No, that's the right. So I'm not looking for a market, asymmetrical dollar bet. You're raising an issue that perhaps we're not paying enough attention to.
I think as the average investor, the average person, I think that risk is way bigger than we think it is. And if you talk to people in government, they would agree with that.
All right, so we only have a certain amount of time. Let's jump to our favorite questions we ask all of our guests, starting with, who are your mentors who helped shape your career?
Well, I think to a few different mentors. I was in elementary school a pretty indifferent student to the point where, I had Indian parents who were like, you're supposed to have good grades. And I didn't have bad grades, but like I was kind of an indifferent student, didn't really focus a lot on school. I had a teacher in third grade who said you shouldn't spend more than 30 or 45 minutes on your homework. I'd go home, look at the clock, 45 minutes, close my book. And then I had a teacher in sixth grade, Mr. Brown, I'll never forget Mr. Brown, who for whatever reason, and I still can't tell you why, saw some potential, saw something in me that maybe other people didn't see. And all of a sudden, I went from like an indifferent student to like a straight A student. And it was that year. He took interest in me. He would say, hey, look, you're really good, right? You should focus more on these things. And so for me, sixth grade, Mr. Brown, very transformational. Mentor in a way, because he made me believe that I had something that I didn't really think I had. And then my dad gave me three important things. He told me was, one of them is kind of funny. He's like, you really need to learn you need to be able to speak well. You need to be able to read well. And he's like, if you're living in this country, you should know how to play a sport, right? Huh. And so the way he tried to implement those is he made me take a speed reading class in elementary school.
Was that useful?
I speed read.
You do?
Yeah.
No loss of comprehension?
No loss of comprehension. he made me take a public speaking class with college students when I was in high school, and I was so scared of public speaking. I never could imagine then that I'd be doing a podcast. And he didn't succeed on sports, but his idea was, he was like, you should learn how to play golf. Like that'd be a good thing to know. And at Livingston High School, no, well, I play golf horrifically, but in high school you could join the golf team. It was a no-cut team. That doesn't mean you were going to get to play, but
varsity letter.
But you got to learn. And I just said, I'm not doing that. So I got 2 out of the 3, but I think those 2 out of the 3 have been really, really important and
really?
have had a very, very positive impact on my life. And of course, along the way, there have been lots of people at all the places I've worked that have been mentors as well.
Very, very interesting. Coming up, we continue our conversation with Deven Parekh, Managing Director at Insight Partners. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. My extra special guest this week is Deven Parekh, Managing Director at Insight Partners. Let's talk about what's keeping you entertained these days. What are you watching or listening, streaming, podcasts, anything along those lines?
We could do we could do a podcast on the podcast. But my wife and I just finished watching Friends and Neighbors with John.
So good.
I thought it was great.
So good.
I really enjoyed it. That's just pure kind of entertainment.
Absolutely.
On the podcast side, I just like I speed read, I can only listen to podcasts if I speed listen. So I listen to all these at 2.4x. Which drives my wife bananas because I'll get in the car and, I'm listening to something. It goes to the Apple thing and she's like, turn this off. But, there's a bunch. Interestingly, in reading, I tend not to read a lot of businessy books, but in podcasts, I do listen to that. But the ones I listen to Acquired, I listen to Business Breakdowns, I listen to Nikolai Tangen's, where he interviews the CEOs. I listen to Invest Like the Best. I listen to you. I listen to Lex Friedman, and then I'm
at the FT.
No, Lex Friedman's got his own. He's a affiliate with MIT in some way.
Oh,
but he's got his own podcast. He gets really, really interesting people to come on. I'm involved in Carnegie and CFR, so they both have a podcast. One's called Grand Tamasha, which is on India, which is just a policy area I'm interested in. Why It Matters is CFR's podcast. So I've got driving to the Hamptons is easy because I have hours and hours of kind of content.
Really interesting. Let's talk about books. What are some of your favorites? What are you reading currently?
Well, I read a lot, and I think 2 books that I just gave. Both my one kid just graduated from college, and one is 2 years out of college, 3 years out of college. I gave both of them. I don't know if they've both read both, but I gave them both books to read. One is Psychology of Money by Morgan Housel.
Sure.
I thought that was a great book. I wish I read that when I was 21, but I still felt like it was valuable. The other is called 5 Types of Wealth by Sahil Bloom.
Sure.
I thought that was a great book. And those are more, I wouldn't put those as entertainment, but I found those, if you read those books and you kind of try to apply them to life, I thought both of those were really useful. Then a lot of what I read is around topics that are around our philanthropy, right? So, one book I read, which is, this is not an upper. It's a book called Anatomy of an Epidemic by Robert Whitaker, which is about the use of psychiatric drugs in this country. And this is not an uplifting book. Of course, there's an epidemic of anxiety and depression.
I was going to say anything about American healthcare or psychology.
But it motivated. So one of the areas that we're philanthropically investing in is next generation ways of dealing with psychiatric conditions, and that book kind of was the starting point, of that. And then the really depressing book I'm reading right now it's a new book. It's called Nuclear War by Annie Jacobson, and we talked about what are these theories, what are the scenarios out there that we're underpricing, and I just felt with what happened over the last 2 years. I think we all we used to have fallout shelters, and
right.
Everyone just think, nuclear war, that's done. There's no risk of that, and I think the last couple of years just reminded me that, like, nah, it's not done. Like, now it's not a high probability maybe, but it's not done. And what this book does is it actually starts at time zero, a nuclear bomb drops, what actually happens, right? What is the defense mechanism that the offensive person uses? What's the defensive mechanism that the other country uses? What happens and it goes into it in not very uplifting detail. And it was just a good reminder that you have this thing out there that still has the chance to obliterate the world as we know it, right? And it's not a 0% probability. It's a low probability. But I think it is important to understand tail cases.
Yeah, to say the very least.
We're ending on a very depressing note, so we might want to start. You might want to end on something more fun.
Listen. Sometimes you mentioned so to make this positive. You mentioned Sahil Bloom. Yeah. I had him as a guest on the podcast. You mentioned Morgan Housel. I've had him several times. He wrote the foreword to my book. Both those guys, younger. All their work is much more uplifting, much less 100%. Depressing.
Yeah, I should have started.
I wonder if that's an age thing.
Yeah, I should have ended with that. But
no, it's absolutely fine. Listen, sometimes you gotta shake people up and say, hey, this is a real risk, and non-zero is a pretty significant risk when the outcome is so catastrophic.
Correct.
So, final two questions. What sort of advice would you give to a recent college grad interested in a career in either startups, venture capital, or private equity?
Yeah, so I think that keep your intellectual curiosity broad. And I was just speaking to our summer interns a month ago, and somebody asked me, like, what's your advice? And I said, like, I think the mistake a lot of people make is they decide, okay, I want to be in venture capital, so all I'm going to do is read TechCrunch and listen to tech podcasts, and it just doesn't make you a very interesting person. And I've probably had more dinners or won deals because we found a common interest in art or a common interest in wine. It doesn't. I'm using the things I happen to be interested in, but it doesn't have to be those things.
Right.
Everyone has intellectual interests outside of the thing that they want to do, and I would encourage them to pursue those with passion, because it's going to make you a way more interesting, well-rounded person. And don't just be so micro-focused on that thing. And I just think it makes you a better investor, makes you a better person, makes you more interesting. So that's one. Two, in a world where we start getting people to do varsity soccer when they're 3, allow a little serendipity in your life, right? I wouldn't have ended up doing what I was doing if I just followed the plan. Something's interesting, try it. And it turns out you might like it. Now, you might not like it and go back to your original plan, but we've forgotten serendipity. It's why I still subscribe to paper newspapers, because I'm probably the only person in my building that might still get paper newspapers, but because there's serendipity. When you're flipping through the newspaper, it's the article that you weren't looking for,
right,
is where you learn something. Guess what?
You don't have that same discovery. And I am very aggressive looking for interesting things.
Me too. And I think you don't get that.
You really don't.
Economist is a great example. If you just get the digital economist and you just see the article on AI, I'm going to read that. Guess what? I probably already know that, right? I'm reinforcing knowledge that I have. Maybe I learned one tidbit that I didn't know. It's when you open it up and, there's this interesting article about nuclear that I don't know anything about, and I read it and say, oh wow, this is a real tail risk. Maybe I should understand this.
I will give you the one exception to this is the Times doesn't do this well, but the Wall Street Journal does. So you go to the digital edition of the Wall Street, WSJ.com, but you could also click in today's paper. And you get the breakdown by sections, and then money and invest,
and then you can kind of click through.
And as you scroll through it, it's the equivalent of flipping a newspaper page, where you get those. Oh, I never would have.
People always laugh because I show up on I'll show up on a plane and I've got my newspapers, and they're like looking at me like I'm like a Martian, and I'm like, no, there's a reason.
No, absolutely. Yeah. And our final question: what do you know about the world of investing today that would have been helpful to know back in 1995 when you were first getting started?
Well, I think a really important one, it applies to investing, but I also think it applies to life, is oftentimes people don't trust their instinct because they don't think their instinct is a real thing. They think their instinct, the gut, they have these words that people use. But the reality is it's micro-slicing a lot of data that you've experienced over your life. Now, maybe at 21, your gut's not worth a lot, okay? It's probably worth a lot in certain things, maybe some human interactions and things like that. It's probably not worth a lot in investing because you just don't have a database. But even at my age, you have this inclination to not trust your gut. Like there's something about this deal that just doesn't make sense. But the revenue looks good and the margins look good, and so I'll just overlook my gut. And I've just generally, when I've overlooked my gut, it's not been a good thing.
You mentioned pattern recognition earlier. Your intuition improves as you get more experience.
As you get more experience and more data.
Blink is perhaps overstates the case, but there's a lot there.
But it's. I agree. I've read the book, and I think it overstates it. But there's something there at the core. And then the second one is, I think, what we talked about earlier. Good times come, bad times will invariably come, and good times will invariably follow. And you just have to have confidence that both are going to be there, and that you're going to learn from both.
Deven, this has been absolutely fascinating. Thank you for being so generous with your time. We have been speaking with Deven Parekh, Managing Director at Insight Partners. If you enjoy this conversation, well, check out any of the 550 we've done over the past 11 years. You can find those at Bloomberg, iTunes, Spotify, YouTube, wherever you find your favorite podcast. Be sure to check out my new book, How Not to Invest, the ideas, numbers, and behaviors that destroy wealth and how to avoid them, How Not to Invest, wherever you find your favorite books. I would be remiss if I did not thank the crack team that helps put these conversations together each week. Alexis Noriega is my video engineer. Anna Luke is my producer. Sage Bauman is the head of podcasts at Bloomberg. Sean Russo is my researcher. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.